Investing for beginners. The biggest misconception about investing is that it's reserved for the rich. That might have been true in the past, but the barrier to entry is gone today, knocked down by companies and services that have made it their mission to make investment options available for everyone, including beginners and those who have just a small amount of money to put to work. In fact, with so many investments now available to beginners, there's no excuse to skip out, and that's good news because investing is a great way to grow your wealth. Why investing is important. You might have heard someone reminisce about the cheap gas prices or some other product or service used to be back in the day. This is because inflation erodes the value of money as years go by. By investing, you can better combat inflation, increasing your chances of being able to afford the same amount of goods and services in the future that you can today. Investing helps you make your money work for you because of compounding. Compound earnings means that any return you have are reinvested to earn additional returns. And the earlier you start investing, the more benefit you gain from compounding. Never done it before? Here's what to consider. If you are a beginner to investing, there are some things that to think about before you jump in. Your goals and time horizon. Consider what goal you are wanting to achieve by investing and your time horizon, the length of time you have to invest before reaching that goal. If the time horizon to your goal is short, investing might not be the best solution for you. Risk tolerance and diversification. All investments have some level of risk and the market is volatile. It moves up and down over time. It's important for you to understand your personal risk tolerance. This means gauging how comfortable you are with the risk or how much volatility you can handle. When investing, a good rule of thumb is not to put all your eggs in one basket. Instead, diversify. By spreading your dollars across various investments, you can reduce the investment risk. This is why the investments we outline below use mutual funds or exchange-traded funds for the most part, which allows investors to purchase baskets of securities instead of individual stocks and bonds. The best investments for beginners. Number 1. A 401k or other employment retirement plan. If you have a 401k or another retirement plan at work, it's very likely the first place you should put your money, especially if your company matches a portion of your contribution. That match is free money and a guaranteed return on your investment. You can start with as little as 1% of each paycheck, though it's a good idea to aim for contributing at least as much as your employer's match. For example, a common match arrangement is 50% of the first 6% of your salary to contribute. To capture the full match, in that scenario you would have to contribute 6% of your salary each year, but you can work your way up to that over time. When you elect to contribute to a 401k, the money will go directly from your paycheck to the account without ever making it to your bank. Most 401k contributions are made with pre-tax. Some 401ks today will place your funds by default in a target date fund. More on those below, but you may have other choices. To sign up for a 401k or learn more about your specific plan, contact your HR department. Number 2. A robo-advisor. Maybe you're on this video to eat your peas, so to speak. You know you're supposed to invest, you've managed to scrape together a little bit of money to do so, but you would really rather wash your hands of the whole situation. There's good news, you largely can, thanks to a robo-advisor. These services manage your investment for you using computer algorithms. Due to low overhead, they charge low fees relative to human investment managers. A robo-advisor typically costs 0.25% to 0.50% of your account balance per year, and many allow you to open an account with no minimum. They are a great way for beginners to get started investing because they often require very little money and they do most of the work for you. That's not to say you shouldn't keep eyes on your account. This is your money. You never want to be completely hands-off, but the robo-advisor will do the heavy lifting. And if you're interested in learning how to invest, but you need a little help getting up to speed, robo-advisors can help there too. It's useful to see how the service constructs a portfolio and what investments are used. Some services also offer educational contents and tools, and a few even allow you to customize your portfolio to a degree if you wish to experiment a bit in the future. Number 3. Target date mutual funds. These are kind of like the robo-advisors of yore, though they are still widely used and incredibly popular, especially in employer retirement plans. Target date mutual funds are retirement investment that automatically invest with your estimated retirement year in mind. Let's back up a little and explain what a mutual fund is, especially a basket of investment. Investors buy a share in the fund, and in doing so, they invest in all of the fund's holdings with one transaction. A professional manager typically chooses how the fund is invested, but there will be some kind of general theme. For example, the US Equity Mutual Fund will invest in US stocks, also called equities. A target date mutual fund often holds a mix of stocks and bonds. If you plan to retire in 30 years, you could choose a target date mutual fund with 2050 or 2055 in the name. That fund will initially hold mostly stocks, since your retirement date is far away and stocks returns tend to be higher over the long term. Over time, it will slowly shift some of your money towards bonds, following the general guideline that you want to take a bit less risk as you approach retirement. Number 4. Index funds. Index funds are like mutual funds on autopilot. Rather than employing a professional manager to build and maintain the fund's portfolio of investments, index funds track a market index. A market index is a selection of investments that represent a portion of the market. For example, the S&P 500 is a market index that holds the stocks of roughly 500 of the largest companies of the US. An S&P 500 index fund would aim to mirror the performance of the S&P 500, buying the stocks in that index. Because index funds take a passive approach to investment, by tracking a market index rather than using professional portfolio management, they tend to carry lower expenses ratios, a fee charged based on the amount you have invested, than mutual funds. But like mutual funds, investors in index funds are buying a chunk of the market in one transaction. Index funds can have minimum investment requirements, but some brokerage firms, including Fidelity and Charles Schwab, offer a selection of index funds with no minimum. That means you can begin investing in an index fund